Perhaps you thought that you had the ability to take a lot of risk in your portfolio, but all of a sudden, the first 3 days of August, you thought otherwise. If so, stay tuned to this week's episode of the Retirement Income Source, where it's all about the income. Welcome to the Retirement Income Source, where it's all about the income. I'm David Scranton, here with my good friend and co-host, Sarah Samuels. And today, we're doing a follow-on show to our show last week. Last week, we talked about the 5 factors that really affected the dramatic market fall off, a loss of 2,000 points on the Dow in the first 3 business days of August. But today, we're going to talk about what that does to your risk tolerance level. You know, a lot of people have, maybe you can relate to this, have become complacent because the market's gone up for a while, and maybe you think that, hey, I'm more risk tolerant than I really am, but all of a sudden, bam, there it goes, and you get that uneasy feeling in your stomach in the first 3 days of the month. Well, if that's you, well, then this show is for you.
Yep. Dave, it's great to be here with you, of course, this week and with all of our listeners. And last week, I implored our listeners to go check out retirementincomesource.com to check out our interactive map and find an income specialist because of what we're talking about today, about risk tolerance. And really, if you're not allocated properly, because let's face it, a lot of people wait to the last minute. People naturally want to procrastinate. People are resistant to change. So by reallocating now, you can make a great decision really for the future.
That's right. And you know, it happens all the time, right? People don't realize how risk averse, right? Risk averse is the opposite of risk tolerant. They don't know how risk averse they really are until they take a major drop. And sometimes it's too late.
And I think some people, too, they get confused about risk when it comes to finances. Some people might think, hey, you know, I'm a risky person. Maybe I like risky activities like skydiving and things like that. But risk is a whole different animal when it comes to your finances and the way that you're looking at your goals, especially as you enter retirement.
That's right. You know, money's an emotional thing. It really is. I mean, it's funny. I heard, you know, of course, you know, as an ex-bodybuilder, I'm pretty self-disciplined, right?
Right. A lot of discipline, the way you eat and work out.
Yeah. And so to me, it's easy. You want to lose weight, you just eat less. That's easy. I just solved the problem, right? So it's funny because I was talking to a friend of mine a few years ago, and he talked about his relationship with food. So I went home and I talked to Teresa, and you know, she's a nutritionist and personal trainer, right?
Yes.
So
Teresa's really fit herself, so I know you guys are into nutrition.
Yeah, so I said, what's he talking about, relationship with food? And she said, that's a real thing. You know, people have a relationship with food.
Yeah.
And it's an emotional thing when you eat and don't eat, right? Which I didn't realize because of just what I had to do younger being self-disciplined.
Right.
But that's even more true when it comes to your money, right? Especially if you earned it. Now, if you inherited it, maybe not. But if you earned it, you know, you made sacrifices every step of the way. Every time you earned $1, you had to decide, do I spend it or do I save it, right? So if you save it and you see it start to disappear, that is an emotional relationship.
Yep. And it can be difficult to unwind your emotions when it comes to risk, and especially your relationship when it comes to money. We have a great question from Janet out of Virginia. And she says, you know, is my risk tolerance all pretty much the same all the time, or would it change based off of my different goals?
Who's this again? I missed the name.
This is Janet.
Janet from Virginia. All right. Well,
yes.
Well, of course, it changes based upon goals to some degree, how important the goal is to you. Okay, so for example, if it's something like paying for college for your child, that might be pretty important. So you might say, okay, I've got a lower risk tolerance there because I can't afford to lose. Retirement, as you're younger, it might be a greater risk tolerance. As you get closer, you might think, okay, I've got to lower that risk tolerance. But what if, you know, you were saving for a second home? You might say, okay, well, I have a nice first home. I don't really need a second home. So you might say, well, I could take more risk there, right? And if it works, I get my second home sooner. If it works, maybe I get a second home and have money left over. If it doesn't work and I have to wait longer to get my second home because I get stuck in a downdraft in the markets, you know, so be it. So it absolutely positively depends upon the goal and that goal's importance to you. And, you know, like I said, retirement, as you get closer to it, usually that reduces your risk tolerance because when you start getting certainly within 10 years of retirement, you start to think, okay, you know, I want to retire. I don't want to work another 10 years. And we always talk about on the show how in the first 13 years of the century, the market was underwater, right? And it happened at once. It tells us it can what?
happen
can
again.
happen again. That's right. So the reality is that, unless you're willing to postpone retirement for as many as 13 years, that's why people really want to reduce their risk as they get close to it again. So yes, it definitely depends upon the goals. But like I said before, it also depends upon whether you earned it or whether it's inherited. If it's inherited, it might be different. It's found money. If you win a lottery, it's found money. But if it's money that you worked hard to earn, and you know that, you bought a more conservative car so you could save more money in your 401k every month, or maybe you took a more conservative vacation so you could save more money, then you made sacrifices. And now you're emotionally connected to that money. And in that case, no matter what the purpose, you're probably going to have a greater risk aversion than propensity to take risk. Because again, you've made sacrifices to get it.
Yep. And Janet, I hope that helps answer your question. And if any of our listeners or even our YouTube viewers have a question maybe about risk tolerance or all the different factors that were affecting the markets at the beginning of the month, a question that you would like Dave to potentially answer on a future show, all you have to do is send us an email to askdave@retirementincomesource.com. You're listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we are talking about risk tolerance. Really the basics of it, what it is, how to know if you're at the correct risk tolerance for where you are in life. Dave, you just answered a question from Janet in Virginia who said, hey, is it the same all the time, or really does it change based off my goals? And I think goal setting, that's where it really all begins, of how important that goal is to you, how urgent that goal is, or how far away or not far away it is. So how can people get started when it comes to figuring out their goals?
Well, it's goals are part of it, and I want to talk about that.
Yeah.
I want to talk about that, but I think I want to relate a personal story, if I can, to our listeners, because, obviously I know what I'm doing. I've been in this business for 37 years, right? So I should be not as emotionally attached. But when it's your money, you are emotionally attached. So, for example, I've had a little bit in Magnificent Seven for a while, just a little on a speculative nature, and I'm still up. So it didn't bother me as much that I was up, because I was still up. And yes, I gave back some of the house's money. So giving back the house's money is almost like, well, I inherited it, or I won the lottery. So yeah, not a big deal. But recently, about 4 weeks ago, we started to see a rotation, Sarah, into higher dividend value companies. And I had some cash on the side. So a couple weeks ago, I dispersed that cash 2-3 weeks ago into some higher dividend stocks. And those stocks went down. And ironically, even though the Magnificent Seven I held went down more on a percentage basis, the ones that bothered me emotionally were the ones that I bought more recently, because I wasn't playing with the house's money. I was underwater. I literally was underwater relative to my purchase price. And even though I know it's all short term, that affected me more.
Yeah, it always is going to affect you when you have to come out of your wallet. It's a different story. And I think even for someone, a financial professional, someone who's worked in the industry, if you're feeling that, I'm sure our listeners are feeling kind of the same way.
And that's emotional. That's right. But you asked about goals. Right. And we talk a lot on the show about goal setting. It's been a while since we've done a show on goal setting. But the reality is that the first step is to set your goals and to figure out, okay, what do you want to accomplish? Everything you want to have, do, or become in your life, and put a price tag on it. And then work to save and invest and accumulate toward those goals. And that will help determine the importance of that goal, and therefore how much risk you could take. Also help you determine time horizon, right? The longer time horizon, generally speaking, the more risk you take. The shorter time horizon, the less risk that you want to take. So that'll help you right there with the goals. And then you also want to then go to the risk tolerance, the emotional side. In other words, yeah, I've got enough money, I can take a little bit of risk and still reach my goals, but is it going to make me feel bad? Am I going to not sleep at night? And then I've also got to tune down the risk tolerance again. So coming up, we're going to delve more into how to determine your specific goals, and how those specific goals can affect the amount of risk you take or don't take in your portfolios. I'm David Scranton, here with Sarah Samuels, and you're listening to the Retirement Income Source, where it's all about the income.
Welcome back to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and today we're talking all about risk tolerance and how to determine if you have the right risk tolerance, especially for your stage in life. And this comes after we've seen kind of a rough couple of days, the beginning of the month in August, and that might have some of our listeners concerned. So, Dave, we wanted to break it all down and really talk about risk tolerance, because there's a lot of emotion that goes into it. And I love that story that you relayed about how it felt a little bit more painful when you were already down and you had to actually come out of your own wallet when you were losing some money,
Yeah,
so.
when I had stocks with built-in gains, and
Yeah.
those dropped in value more on a percentage basis, but because the gains were built in, I'm
Right.
still playing with the house's money.
Right.
But the stocks I bought 3 weeks ago, they blew down through their cost basis really quickly, and I was in a loss position. That hurts. I feel like it's money coming out of my principal.
Yep.
And that doesn't make any sense from an investment standpoint. Economics says it doesn't matter what you paid for something. That's a sunken cost. All that matters is from today forward. So economics would say emotionally I should feel worse about my Magnificent Seven stocks I had because I lost a bigger percentage.
Right.
It
But you
doesn't,
don't.
Right. It doesn't matter that I bought them way down at a lower
Right.
price.
Yeah.
But again, this is why it's an emotional decision.
It's not always logical,
Yeah.
exactly. But since this is the retirement income source, Dave, and we are talking about goals because that's all tied in with risk tolerance, let's start with retirement goals. How
Sure.
can our listeners get started setting those retirement goals?
Well, the most important thing is to realize that the goals fall into three categories. Everything you have, so you want everything you want to have, do, and become. So it's lump sum goals, which are more prevalent in younger years. And then as you get older, they start to become more do goals and become goals. They become more experiential in terms of what you want to do, travel, things like that, experience, and then also become. What do you want to be known as? Do you want
Your
to leave
legacy.
you want to leave a legacy? Exactly. And that's why I always say, part of leaving a legacy is, it's morbid, but writing your own eulogy while you're alive and see what people say about you, what you'd want them to say, and then work your way backward. But, I think the most important message from an investment standpoint is that if you're retired today, okay, and you're not, and the income that you are taking is not being satisfied through interest and dividends, or you're just retiring now and you're not generating enough interest and dividends to satisfy your income, then you need to make a reallocation immediately, because anything that you take out of principal means you're selling shares, you're liquidating principal, and it's a slippery slope. With people living longer and longer now, they can run out of money. So it means that you might have to lower your risk to get more interest and dividends. It might mean a little bit less growth, but you might have to make that decision. Now, if you're further away from retirement, now it depends upon lots of other factors that we'll talk about right here in today's show.
Right. You mentioned, Dave, as well, that if you're a little bit further away, you can always potentially take more risk depending on how soon that goal is going to be happening. Let's get to our next Ask Dave question. We have Brad from Tennessee. He says, Dave, you've talked about the I want versus I need goals, but I'm having a really hard time differentiating between the two of them.
Well, Brad, I always suggest people do this when it comes to setting goals for retirement income. Take a look at your income today and subtract expenses that are going to go away, right? So you're probably not going to put money in your 401k anymore, Brad, when you retire. So you can subtract that. You're not going to pay FICA tax when you retire because that's only on earned income from employment. So you can subtract that. If you plan to have a mortgage paid off, you could subtract the principal and interest component of the mortgage. If you're putting money in a credit union, saving money every month, you can subtract that. Any debts that might be paid off, credit cards, that if they're going to be paid off in retirement, then you could subtract those payments. So eventually you get to a bottom line is this is how much, and by the way, make some tax adjustments, but then you get down to, okay, this is how much money I need pre-tax right now to live the same lifestyle I have today. And that's going to be a lower number than you're actually earning because you subtracted those expenses that have gone away, right? Now, that's your I need goal. That's what you need to live the same lifestyle, because I'm sure you don't want to live a lesser lifestyle in retirement. But then, Brad, here's the rub, right? You retire, you have more time on your hands. More time on your hands means you're going to want to do more things. Doing more things means you're going to want to spend more money. And this is when you got to sit back and think about everything you want to have, do, and become in retirement. And really dream about what retirement's going to look like for you. I suggest sometimes, saving up your retirement time. You get 4 weeks, take off 4 weeks in a row 1 year and just pretend you're retired. Live like you're retired. See what you do to fill the time and try to attach dollar amounts to that. And most people find that, if calculating their I need goals is a lesser number than their current income, when they add back the things they're going to want to do with all that spare time, it comes right back up to their pre-retirement income, in many cases, maybe even more. So again, you really have to do some deep goal setting process to know what you want to do in retirement, or otherwise you'll have a negative surprise. And of course, nobody wants that.
Brad, thank you so much for sending in your Ask Dave question. And if any of our listeners have a question maybe about your goals or ways to get started with setting them, especially as you are going into retirement, please reach out to us. You can always send us a message to our email. It's askdave@retirementincomesource.com. You're listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and today is all about risk tolerance, determining what your risk tolerance is. We're also talking about ways it can change depending on what your goal is. And traditionally, Dave, you mentioned that if a goal is further away, you can always take a little bit more risk. But it's different when it comes to your retirement. A lot of people have an emotional reaction when it comes to the change. You know, that idea of going from the paycheck and earning your paycheck for 40 years or more even to now, okay, I'm going to have to fund the next 30 years of my retirement. And it's a big number sometimes. It's hard to conquer.
And the problem is people think of retirement as, oh boy, I need to decumulate. This is I had my accumulation years, now I have my decumulation years. And they're really not decumulation. If you do it right, they should be income years where you're keeping your principal intact and living off the renewable resource of interest and dividends, like we always talk about every week on the show, Sarah.
Right.
So the issue becomes, are you ahead or behind of goal, right? If you're ahead and you say, okay, I've got enough interest and dividends being generated now and I'm a few years out of retirement, then you might be able to take some more risk with the rest of your money because you've generated enough interest and dividends between bonds and preferreds and high dividend common stocks and all that. If you're not and you're a few years before retirement, but yet you look there and say, okay, if I put my money in income producing instruments, and let's say I could earn, 5.5%. Yes, I have enough money today to retire. Then you want to start making that transition. You want to start making it now from a total return focus, irrespective of where it comes from, to an income first, growth second approach.
Right. Okay. Really looking at where that money's coming from, form of income.
But sadly, there's going to be some people a few years out of retirement who, if they do that calculation, they say, I don't have nearly the income I need or want. They're behind the eight ball. And for those people, they may stay growth oriented longer and roll the dice longer. Why? Because they can't afford to retire anyway. And it's unfortunate if that happens, but that's reality. And that person might be better suited by taking more risk if they truly are behind the eight ball. But if you've done a good job saving, accumulating, investing, then most likely you need to make that transition.
Yep. And I think that's what's so important about determining your risk tolerance. It really comes down to, after you've figured out your goals, where you are when it comes to those goals. You know, like you said, Dave, you really don't want to be decumulating. And a lot of people don't want to be they don't want to be forced to have to do anything in retirement because they don't have enough money. You know, you should be focusing on income and getting income the right way and interest and dividends as opposed to spending down principal.
And you have to remember, like I said before, if we had 13 years at the turn of the century where the market was underwater, the fact that it happened once tells us it can what?
It will happen again.
It can happen again, right? So you have to say to yourself, okay, if I don't make that transition early enough, but I have enough money today, if I went to an income first, growth second model, I'd be fine to retire. Yeah. But you don't make that transition and you're forced to work 5, 10, or even 13 years longer, is that okay? Right. Is it okay if you're forced to work that much longer, or you're forced to retire on that much less, or you're forced to take it out of principle knowing that's a slippery slope? And if the answer is no, then you have to make that transition.
Yep. And I think that's why a lot of people really struggle with this, because you have to dig down deep. You have to really think about how you would feel and what it would look like if you did have to return to work, if you did have to maybe sell your home that you want to keep in retirement, how difficult that is. Yeah. And that helps a lot determining it.
And what most people think is if you want more income, you have to take more risk. Well, the reality, and I don't say this enough on the show, Sarah, is that when you go to an income first, growth second approach, you actually reduce your risk. So if you're concerned about the amount of risk you're taking, making that transition is helpful. But right now we're talking about the left brain reasons to lower your risk. The fact that, hey, if you're close to retirement, you have enough to win the game of life financially speaking, you may want to lower your risk. But really it's because you want to go to an income first, growth second approach. Later in the show, we'll talk about, the emotional reasons, even above and beyond that you might want to consider making a risk adjustment.
Absolutely. Well, Dave, you mentioned the have, do, and the become goals. So a lot of our listeners might be thinking, hey, when I retire, I'm going to get this vacation home I've always wanted or that new car. But there's a way, your risk tolerance will affect the way that you invest for your lump sum goals. So Dave will break all of that down. I'm Sarah Samuels here with David Scranton, and you're listening to the Retirement Income Source, where it's all about the income. Welcome back to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton. And if you have struggled with determining your risk tolerance, especially as you move through life and you've come into different stages in life, well, this is the show for you. Today, we're talking all about how to determine your risk tolerance. And it really, David, starts with the goals and determining your I need and your I want goals. And from there, you can figure out how you need to focus on those goals, how you actually need to achieve them, and how that might make you more or less risk tolerant.
That's right. That's right. And when we talk about I need and I want, we talk about income. Yeah, I need income. Yeah, I want income, like we did in our last Ask Dave. But the reality is that also applies for lump sum goals.
Right.
Right. There are certain things that are really important to you that are I need lump sum goals. Like you might need a new car every so many years. Okay, that's a lump sum goal. Or for some, you might want an RV, they may want a fishing boat, and it might be that important to them. That's an I need, or it might just be a nice to have, and I want.
Some of our listeners, they might need to do some renovations on their home. Maybe as they get older, that could fall into the I need as a lump sum goal.
That's right. And so part of what affects the amount of risk you take on lump sum goals is whether it's an I need goal or an I want goal. If it's I want, you can mathematically take more risk. But the other one is a time horizon, right? It's always about time horizon. And I say 13 years because, again, we were underwater for 13 years. The market's at turn of the century. Most people say 10. So even if we wanted to say 10 years for discussion purposes, if you have a goal 10 years out, you could be a little more aggressive, probably primarily stocks. Maybe have a total return focus regardless of whether it comes from the I or the G, the income or the growth. But, as you get closer, you need to lower your volatility risk. Which means, number one, you need to be diversified. You can't have too much money in one stock, or even too much money in the Magnificent Seven.
Right, a sector of stocks, exactly.
You can't have that. But also you have to balance out the stocks and the bonds and the cash. Remember, there's different asset classes, and by mixing them together strategically, you create a little bit of an alchemy where sometimes one zigs and the other zags, and you can lower your volatility. So, there's two types of risk. There's risk of loss. I'm going to lose my money because I'm not diversified and I speculated in one or two things. And then there's the volatility risk. So assuming that our listeners are smart enough to say, hey, I'm diversified, now we're down to the volatility risk. If the markets drop and they happen to drop right around the time that you want to make that purchase, are you okay postponing that goal, right? So one component is, hey, is it I need goal or I want goal? If it's just I want, maybe you could take more risk. I need, you don't. Second component is, of course, the time horizon.
Right, how far away it is, exactly.
That's right. And, the third one is really the willingness to postpone that goal if you get stuck in a market trough. And that's up to everyone on an individual basis.
Yep. And some goals you just can't postpone, so you have to make a decision. Let's get into our Ask Dave question. This comes from Amy in California. She says, what if we plan to buy an RV in retirement and we plan to finance it? How will that affect my risk tolerance decisions?
All right, Amy. Well, first of all, I want to start by saying that I'm not a big fan of financing lump sum purchases in retirement. I'm really not. Going in with cash is really a big benefit. In fact, later on the show, I actually want to regurgitate a story I've told many times on the show about a client of mine in my early years that taught me about why you should pay cash for automobiles, for example. But the one time you might want to consider financing it, I believe, you shouldn't finance it because you don't have enough money. You should only finance it if you don't have enough money to buy this thing, well, then you shouldn't own it, right? But if you have enough money to buy it, but financing makes more sense than paying cash, well, then, we can look at that. So one example would be if you have a lot of money in 401ks and IRAs, right? You've lopsided toward that pre-tax account. If you pulled out a few $100,000 to buy an RV, you're going to have to pay tax on it all, and it's going to cost you a lot more money. That's a great situation where you've got the money, but there's this tax lien on it. So you might finance the RV and then just take out installments, right, from the I, hopefully from the interest and dividends from the IRA, from the 401k, and pay taxes to pay off the note, right? And in some cases, the case of an RV, it could be a second home. The interest could be deductible, which means now you're taking more money out of your 401k and IRA, paying taxes on it, but then you have a deduction to offset it. So that could work. The other thing is if you have enough money, but yet you have a drop in the markets, and now you say, okay, I want to finance it just because I don't want to sell right now. I have enough money, but I don't want to sell when markets are down. Okay, well then You're not financing because you need the loan to buy this thing, the RV in your case. You're taking the loan because you don't want to sell the asset when it's down to buy the RV. And that might be a good time to finance it. And by the way, if the markets are down, usually we're in a bad economy, a recession, it means that's when interest rates are lower. And that also means that you could probably lock in some good low interest rates, finance rates at that time. So, Amy, I hope that kind of clarifies a bit when and when not to finance.
Yep. And Amy, thank you so much for sending in your question. And if any of our listeners have a question maybe about something that you are interested in financing, maybe the reasons why you would prefer to finance it, please send us your questions. We love to hear from our listeners. You can always email us at askdave@retirementincomesource.com. You're listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with Dave Scranton, and we are talking about ways that you can help determine your risk tolerance and how your relationship with risk will really change, or how it may change, especially as you enter retirement. Dave, and I think that was a really great question from Amy, because you basically answered it saying, hey, it all depends on your specific situation. It's always better if you have the money in hand to pay cash for investments versus financing it. But if you have specific reasons, maybe, it makes more sense for her financially, but she does have the money, then, hey, maybe it's okay to finance it.
And it's not bad. And it also depends upon, is this something that, for 25 years, Amy's been thinking, oh my goodness, I'm going to retire and get this RV and go around.
That's
is
her
it that
dream.
pressing?
Exactly.
Or is it just kind of a side goal? That's a big dependent. Of course, in the case of living in California, she could probably sell her house, get the RV, move over the border, right? And all the money she saves in state income taxes, she could pay for the RV. So that might be another reason to finance it.
Move over the border in the States, or move to Mexico? Because a lot of people retire in Mexico.
No, over the border in terms of the States.
Okay, it's still in the States.
I want to bring up a conversation. My client, Iraj, Middle Eastern client of mine, back in the late 1980s. Great guy. And I've told this story before, so if you're a regular listener and you're hearing the story a second time, well, just bear with me, okay?
It's important. Please, it's a good story.
Bear with me. It's a good story. And he told me he had no debt, right? And I know in the Muslim culture, it's really debt is evil. Debt's a sin because it's slothful money. It's you're paying interest, and it's also a sin to collect interest, right? So I get this. So he told me he had no debt, no surprise there. But then we're going through his budget a little bit at a time, and he said, "This is my car payment." I looked at him. I said, "Well, you said you had no debt. What are you talking about, car payment?" Yeah. Well, come to find out, what he did was he had done the math, and of course that's when interest rates are where they are now, right? Car loans now 7-8%. They're back to where they always had been, not where they'd been in the last decade and a half. And he said, if I could put my money in the bank in a money market at 5%, as you can do today, versus buying a car and paying 7 or 8% interest, I could save $350 a month and buy XYZ vehicle. But if I had to go buy XYZ vehicle and pay for it in arrears over 5-6 years, it would cost me $500 a month. So he said, look, if I'm going to have a car payment my entire life, let me get in the habit of saving the money up front and buying the car in cash. And I'll save almost 1/3 of the payment for the rest of my life. And, that was very good advice that stuck with me. And frankly, Sarah, for many of the recent years we had this radio show, it hasn't worked because, you get zero in the bank, and frankly, financing rates with cars have been zero, right?
Right.
But now that financing rates are back up to a market rate, and you can actually earn some interest in the bank.
Yeah.
Iraj's wisdom really comes back here.
Oh, yeah.
Now, it's harder to do with an RV. If you're saving for an RV or something bigger, you got to start that much in advance, and you should have your RV fund, right? Do your calculations. I'm saving enough money for retirement on a pro rata basis. Unless the markets fall apart, I should be fine, okay? Now let me start saving for my RV. I want to retire in 8 years, 10 years, 12 years. How much do I need to save outside of my 401k, outside of my IRA, so I can have enough money and I can pay cash?
In a way, it's very similar to really living off the income, right? Because you're saving the money ahead of time, in a sense, like your friend Iraj, and then paying from that. So you're living off the income, more or less.
And it's all about delayed gratification. We used that study years ago.
Having discipline, right?
Yeah, I remember the study about the young children, those that wanted the ice cream cone today versus those who would wait an hour and then you get 2 ice cream cones, right?
It was marshmallows, the Stanford marshmallow experiment.
That's right.
Exactly.
And they went back after the fact, and thank you for reminding me. I'm old, I forget things, right?
It's okay, I remember.
But they those that waited an hour and got 2 marshmallows, they were far more successful throughout their lives because they learned delayed satisfaction. It wasn't just about, I need this thing today, and I'm going to get it even if I have to take a loan because I can't afford it.
Yep. And if you look at consumer debt, then you know that's not really a principle that most Americans
Which
have,
has been going up in our
unfortunately.
country.
Exactly, right? We're not really too good at delaying gratification. But there's a lot of complicated emotion, I think, when it comes to risk and really getting to the bottom of it and unwinding some of those emotions you might be having. So we're going to talk about some tips for getting through it so that you can make less emotional decisions, especially when it comes to something like risk. I'm Sarah Samuels here with David Scranton, and you're listening to the Retirement Income Source, where it's all about the income.
And welcome back to the Retirement Income Source, where it's all about the income. I'm David Scranton here with Sarah Samuels. And today we're talking about checking your risk tolerance level, which is a really timely topic after last week's show, where we discussed all the reasons we had that precipitous market drop in the first 3 days of August just earlier this year. And so far, we've covered more of the left brain attributes, right? We talked about in retirement, how to determine based upon your I need goals versus your I want goals, how much risk to take. We discussed how far away from you are from retirement, whether you're ahead of goal, behind goal. And then we talked a bit about lump sums, right? About, your lump sum goals and how to determine when you could take more risk versus less risk. But now, Sarah, I want to get in touch a little bit with our emotional side here. I want to soften it up just a little bit here this evening on our show as we have
Delilah.
our softer music coming up.
Delilah here, yeah.
That's right. And talk about the emotional reasons, because just because you have enough money to win the game of life, financially speaking, and you have money left over, left brain with logical wisdom would say, well, take the extra money you don't need and just roll the dice. It's going to grow. You get more return over the long run. And yes, generally speaking, you get more return over the long run when you take more volatility risk. But how about how you feel emotionally, right? Just like I went through when the stocks that dropped less bothered me more emotionally because I was digging into principal, whereas the riskier ones who dropped more didn't bother me because I already had gains built in.
Yeah. Well, I really think it goes back to people's relationship when it comes to money. Dave, you mentioned that Teresa, she said, hey, Dave, a lot of people have food issues. Maybe that's not something that you deal with, but a lot of people have a weird relationship with food. And the same is even more true when it comes to money, especially people that maybe didn't grow up in a household where finances were discussed, where they were taught financial education. A lot of people are missing that aspect. And then as they get older, they feel a little weird. They feel like they missed something that they should have understood earlier on, and they're hesitant to ask about it. They're embarrassed, So I think all of these emotions go into determining your risk tolerance, how you feel about it all.
When it comes to retirement income, right? You're absolutely correct. A lot of the money is there for security. It's for confidence, because when somebody retires, Sarah, I know you've got a long ways to go, but when you retire, it's a big paradigm shift. I had my client I've talked about on the show before. His name was Ed. He was a big executive for a major company in Hartford, Connecticut. He had way more money than he needed to retire and generate the income he wanted. But he made me calculate the math. And I looked at him one time and said, Ed, you're a smart guy. You have triple the income generated from your investments you need. Why? And he said, you don't understand, Dave. My entire life I've gone to work. I've gotten a paycheck. I've paid my bills. I've taken care of my family, and I've saved the rest. I'm giving that up. That's a big emotional decision. So when you come to retirement, it's not just about, hey, do you have enough money? It's about, even if I have enough income being generated, and I'm following Dave's advice, I'm doing the income first, growth second approach, emotionally, how's it going to make me feel if I see my net worth going down?
Yep. And a lot of our listeners might be dealing with differing levels of risk tolerance within the household, like Beverly in Georgia, who submitted her Ask Dave question. She says, Dave, I tend to be more risk adverse, more conservative. Meanwhile, my husband likes to take a lot of risk. So how do we compromise on this?
All right, Beverly. So, yeah, you're not alone, first of all. It's a conversation I hear on a regular basis. So let's break it down. Okay, let's talk about lump sum goals. Okay, you want to redo the kitchen in the house, and your husband wants a small fishing boat. Well, then you should be more conservative on how you invest for your goals, and he could be a little more aggressive for how he invests in his lump sum goal, right? Because he's willing to take more risk, which means if he doesn't want it, if he doesn't get it, maybe he's okay with that, right? So that's part of it. The second answer is you have to compromise, right? Marriage is all about compromise. And Beverly, I don't know how long you've been married, but Teresa and I have been together over 20 years now, and I know it's all about compromise, right? You have to meet in the middle. So for a lot of people, the person who's more aggressive needs to kick it down a notch and be more conservative. And the person who's more conservative, in many cases, is worried because that person doesn't understand and maybe needs to be a little more informed, okay? Just like when I started flying my own plane, Teresa never wanted to fly with me.
She saw the statistics, a small plane crashes.
And she didn't understand flight, so it was an emotional thing, right? So, so part of it was, I fly really conservatively. I fly like an airline pilot, even though it's a smaller plane, right? All process and procedure. But also, she needs to be educated a little bit that the plane won't just fall out of the sky.
Right. There's physics to it, right?
It's going to glide, right? Yep. And that made her more comfortable. There was a little compromise there. And I don't do any steep turns or anything like that to make her nervous.
No barrel
I fly
rolls,
like an
right.
That's no barrel rolls, exactly. So part of it's compromise, and the same thing is true with your risk for your investments. Now, when it comes to retirement, what some people do, not everyone, but some people do, Beverly, is they say, okay, let's take my I need goals and let's have lower risk to achieve those I need goals. And then let's take the difference between the I need and the I want and take more risk there. And that way there, if you have losses before retirement because of your husband's propensity to take risk, it doesn't cut into the bone. You still can cover your I need goals. It might just take away a little bit from some of the things that you want to do. So Beverly, hopefully those words have helped you in some way, shape, or form. Good luck at home.
Yep. Beverly, thank you so much for listening to our show and, of course, for sending in your Ask Dave question. If any of our listeners or even our YouTube viewers have a question that you would like to ask Dave, all you have to do is send us an email to askdave@retirementincomesource.com, and you might hear your question answered on a future show. You're listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and today we have talked all about risk, ways to determine your risk, figuring out what your risk tolerance is, and the way that you should, your relationship with risk when it comes to your goals specifically, if you have a lump sum goal versus the other goals. Now, Dave, a lot of our listeners might be thinking, hey, Dave, that's great. I would be able to get over my emotional issues with risk, but I'm really concerned about maybe my health in the future. Dave, they're worried about healthcare expenses going up. They know they have 30 or more years to plan, and maybe that's something that's really concerning them.
The best way to cover, there are two good ways to cover healthcare expenses. The first one is to have more income than you need every year in retirement. So if you have increased healthcare expenses, you can cover that. I guess a corollary to that would be generate just enough income to hit your I want goals in retirement, but then have assets left over that maybe you could be a little more aggressive with for more growth, hoping that you don't have major healthcare issues early in retirement, right? Yeah. So you have a pool of money down the road with which to cover these healthcare expenses. But so either one is the same. It's like 1A and 1B. But the second answer is long-term care insurance. If somebody's in good health, you can get long-term care insurance. And it's not just an annual premium anymore. In many cases, you can put a lump sum into a certain type of program, which will pay you some interest, but will pay you more if you take sick. So several things that you can do there to cover healthcare expenses. And, it's the key, though, is to always, once you get that taken care of, is always to think about emotionally, how you're going to feel. And the reason that I bring this up and we want to do the show today, of course, Sarah, as you know, is because we just had that drop in the market. It was 2,000 points in the matter of really just 3 business days. And we forget because we had a major drop with the pandemic, but everyone said, oh, we're all in this together. And of course, the markets recovered really quickly. And this has been the first really major drop since then. I know we had a couple that were, but nothing that was really 2,000 points. So, people have short-term memories. You forget how bad it felt. And also, when it happened during the pandemic, hey, that was more than 4 years ago. Maybe you were, 8 years out of retirement then. Maybe you're only 3.5 years out of retirement today. Maybe it affects you differently emotionally. So, Sarah, I always recommend, as you know, telling people to just, close your eyes. Take your money. Let's say you have $1 million. And imagine what it would be like to open up your statement and it's down to 500. Close your eyes and try to live that at this stage of life. What would be going through your mind? right?
I would be terrified, honestly. It would be scary to
At
see
your
that.
stage of life
At
with
my-
many years to
right,
go.
Right. I couldn't imagine if I was in retirement or wanting to retire in a year or less, and now I have half the money left
Yeah,
to retire.
that's
That's
right.
scary.
So now you got to kick it down a notch. Say, okay, what if my million dropped to 750? Now what will be going through my mind? What if it dropped to 850? What if it dropped to 900? And somewhere in there, there's going to be a point where you kind of swallow and say, it's okay, we're going to get through this, versus the evil thoughts going through your head on a regular basis. And that's important because, you know, you are who you are, and your money's there for your security. And if it's going to give you angst and anxiety, well, then, you know, it means you're in a position that's too aggressive. So I encourage each of you listening to go through this exercise. I don't care if you're retired, you're close to retirement, you're far away from retirement, or whether or not you have lump sum goals. Take some time and go through this exercise and really try to determine before it happens how a major drop would affect you. Because then if you could figure out how much of a drop you're willing to take, you could back into how much risk you're willing to take in that portfolio.
Absolutely. Right now is a great time to take your temperature. And thank you for listening to today's show. If you would like to listen to the show again, maybe send it to your family or friends. All you have to do is go to retirementincomesourceradioshow.com, and all of our past episodes are there.
And of course, we also hope that you'll be with us right here next week, same time, same station. I'm David Scranton here with Sarah Samuels, and you're listening to the Retirement Income Source, where it's all about the income.